you, Jeff. Obrigado. Thank you, everyone. It is an honor to be here. I have fallen in love with Portugal in the last few days that I've been in your country. So today, I am going to talk about the disruption of the largest industry on planet Earth. You heard something about healthcare from Divya today. That's a $4 trillion industry. Energy is a $6 trillion a year industry. So I'm a software guy who came into energy late in life, but now, among other things, I'm the co-chair for energy and environment at Singularity, and I'm an investor in early-stage energy startups trying to create the next Teslas and solar cities and so on. But energy we're talking about today, not just because it's an economic issue or a business opportunity, but because it's a moral issue. We are in the 21st century. We are living in a science fiction world, and yet 1.2 billion people on planet Earth don't have access to electricity. And those people who live in energy poverty, in the dark areas of this map, it drains their personal development, their quality of life, their health, longevity, and the development of entire societies. On the other hand, we have this problem that the way that we produce energy has these negative side effects, like the warming of the planet. The planet has been getting inextricably warmer. You see it's a noisy system. It bounces up and down. But as you zoom out in the large view, 3 of the last 4 years set records for new all-time highs. 9 of the 10 warmest years on record have been in the last 10 years. That's what's happening. So this is a serious problem. And then a third issue, which is here in Portugal, energy is also an economic issue because Portugal has one of the most expensive electricity costs in all of Europe. In fact, this is 2017. In 2018 now, Portugal is number 2 in electricity cost, only a second to Germany. Now, the good news on all 3 of these is that the way that we produce and use energy is being disrupted. Now, we use this word disruption a lot. Sometimes we mean something sort of trivial, Uber for cats, I don't know. But that's not what I'm talking about. Let me show you what disruption looks like in energy. This is Peabody Coal. Peabody Coal, largest private sector coal company in the world, or it was in 2011. And then, over a 4-year period, Peabody Coal collapsed. It lost 99.8% of its stock price and then went into bankruptcy. And it wasn't just Peabody. We had 8 large global coal companies that all went bankrupt in a 6-year period. The global index of publicly traded coal company stocks dropped by 90%. It bounced up a bit, so it's only 75% down right now. And this disruption to this industry didn't happen because we stopped using coal entirely. We haven't, not yet, we will. But coal today is still the #1 source of energy on planet Earth. But what happened was that for 150 years, since James Watt's steam engine, the use of coal went up and up and up inexorably until 2013, when coal consumption around the world peaked. And what happened to these companies like Peabody is they thought demand would keep rising. So they took out expensive debt to build new coal mines, new railways, new ports, and then demand stalled and went down. So the price of coal they could get went down, and they couldn't pay off those debts, and they went into a downward spiral that ended in their collapse. Now, many factors led to that decline of coal. Efficiency was probably the biggest one. Cheap natural gas was one, but now that has been surpassed by what's happened in clean energy. So we'll start with wind. Wind power, you know well here in Portugal. Energy in general is a fungible resource. It's one where people will buy the cheapest version of it that they can. So for wind power to really grow on a global scale, it has to be cheaper than coal or natural gas, fossil electricity. And most places in the world, you can build a new coal plant or a new natural gas plant to produce electricity at 6 US cents a kilowatt hour, 5 euro cents a kilowatt hour. But for the longest time, wind energy was ridiculously more expensive than this. Here's data from inside the US. And you see as back in 1980, wind power cost almost 60 cents, almost 10 times what electricity from coal or natural gas did. Now in the US, we sign wind power contracts at less than 2 cents a kilowatt hour. Now that's subsidized. Remove the subsidies. 4 cents, 1/3 cheaper than new coal or new gas in the US, even with no subsidies work on. By the way, Portugal, part of the challenge we have in Portugal, I'm sure most of you know, is that Portugal deployed a huge amount of wind power when it was further back on this curve, when it was very expensive. And that is the hangover of subsidies that you have impacting the country now. But that is sunk cost. That has happened already. The question now is what do we do in the future? And now what we see is around the world, not just in the US, wind power has grown incredibly cheap. Morocco, last year, 2.8-cent wind power, half the cost of coal or gas. Brazil, earlier this year, 2-cent wind power. Mexico, 2-cent wind power. These are unsubsidized prices, 1/3 the cost of coal or gas. Around the world, you see country after country, the cost of wind power electricity dropping below that red dashed line, which is the competitive price of coal or gas in most parts of the world. Now, of course, this price decline depends upon how much wind you have around the world. So you see on every continent, you have some area with these dark red, the very fastest winds on Earth. And if we zoom in a bit, we'll see that here in Portugal, you have substantial areas of very high-speed winds. And so now we are starting to see wind power prices come in at just over 4 euro cents, 5 US cents, in the very cheapest deals on the Iberian Peninsula, including here in Portugal. Just the very beginning. These are just prices we've hit in the last 12 months. So for a long time, we've subsidized it, and now we're able to reap the benefits. Because those subsidies helped scale the industry. What we know about wind, solar, batteries, in fact, every exponential technology, is that they have a learning rate. This is the first exponential. Every time you double the scale of these industries, you bring down the costs. The cost of wind power drops about 20% every doubling of scale. So you have this virtuous cycle. At first, a new technology, whether it's 3D printing or stem cells or AI, is simply too expensive to use in most applications. But you find some market that it works in. And that lets you scale the industry, and it lets your prices come down a little bit. And when your prices come down a little bit, you find another market that will buy it at this new price. And that, in turn, increases demand for your product. And when your demand goes up, your prices fall again. So we've seen carbon fiber has gone through this cycle, gene sequencing has gone through this cycle, and wind power, solar, and batteries are all going through this cycle right now. As we build these bigger and bigger wind turbines, we also gain advantages. Up high, the wind is more steady, and if you double the length of a wind turbine blade, you quadruple the area that it spins through. That also makes wind power not just cheaper, but more steady. We think about the steadiness, the reliability of an energy source in terms of its capacity factor. 100% is it's on all the time. 10% is only on 1/10 of the time. We used to deploy wind turbines that had capacity factors of 10 or 15%. Now, in the best sites on land, we're getting above 50% capacity factor. That's higher than the capacity factor of the coal fleet in China or India. Now, if you really wanted the fastest winds on Earth, you'd go offshore, because the fastest winds are not on land, they are offshore. But for decades, even as recently as 2 years ago, I thought this would never make economic sense. Because building offshore is very expensive, you have to have an undersea component of this, you have to maintain it in salt water, you have to run crews out on boats to fix things. So I would have told you 2 years ago, it's never going to work economically. I was wrong. Last summer, we had 3 bids from 2 companies in the German market in the North Sea where they bid zero subsidy. They bid they would produce offshore wind power with giant new turbines at wholesale market prices. To give you context, here's what's happened to the price of offshore wind. That blue line is major optimists about clean energy, Bloomberg New Energy Finance, and what actually happened exceeded even their expectations. A 4 times reduction in price with the first of these projects coming onto production in 2021. And that's in the North Sea. In Portugal, the winds are not quite as fast as the North Sea offshore. The North Sea has Category 7 winds, but there are Category 6 winds here. And offshore wind is going to keep dropping in price, and you are going to see offshore wind in the areas off Portugal be competitive with wholesale electricity and have capacity factors of 60 or 65%. So this is a major revolution. But what makes wind look slow and stagnant, what's even more exciting, is what's happening in solar power. Jeff told you this morning. The price of a watt of solar panel has dropped from 77 cents a watt to 30 cents a watt over the last 40 years. This is physical infrastructure. This is how we make energy, the most important physical resource we have. Yet we don't see this in the cost of building buildings or building trains or building trucks. It's almost like digital in a physical sector, right? Not quite. Digital has dropped in cost 10 million times since then, but this occupies a middle ground. And so now we have in the sunniest parts of the world crossover, where solar power, unsubsidized, is just the cheapest energy you can buy, period, and is dropping in cost the fastest. So again, 6 cents for a new gas or a coal plant in most parts of the world. India, 3.8 cents solar, 2.4 rupees. Multiple times we've hit this price. The cost of India has dropped by a factor of 4 in just the last 4 years. In Tucson, Arizona, in the US, about a month ago, Warren Buffett, his utility, signed a contract for solar at 2.3 cents per kilowatt hour, less than 2 euro cents. That was subsidized, so really unsubsidized, we got 3.3 cents. Solar at half the cost of coal, maybe more than a third down from the cost of gas. The price of 20-year solar contracts in the US has dropped by a factor of 8 in the last 10 years. In Mexico, this is out of date. We're actually getting close to 2 cents in Mexico. In Abu Dhabi, this is actually one of my favorite photos of all time. We have in one of the oil capitals of the world, solar being built at 2.4 cents. This actually held the world record for cheapest unsubsidized solar for more than a year until Chile beat this late last year, or actually early this year, at 2.15 cents. 1/3 the cost of coal or gas. Less than that. Gas is expensive in Europe and Latin America. 1/4 the price of gas. So everywhere around the world, every country, you see the price of solar just plunging, plunging, plunging. It started off much higher than the cost of wind, actually. But it's plunged and is breaking through those lines of coal and gas prices, unsubsidized, in different parts of the world. And so in the sunny band, solar is now basically the cheapest energy almost everywhere, and it will expand from there north and south over time. Now, I told you 1.2 billion people don't have electricity. Where do they live? Africa, India, South Asia, a little bit in Latin America. So those people live in some of the sunniest parts of planet Earth, and they will have in the long term some of the cheapest energy on planet Earth. And we didn't plan it that way, but I think that is a great bit of poetic justice. So driven by policy and innovation, solar has exploded. This is a log scale. 50x growth in the last 10 years. It took 25 years for solar to get to 1% of world electricity. It took 2.5 years for it to 2%. That's where it's at, 2%. It's still tiny. Solar is still a tiny, tiny, minuscule part of energy, but it's growing exponentially, quite rapidly. And it also has this feedback loop. All right. Now, solar really got its start here in Europe. It was really Germany, and to some extent Italy and Spain, that heavily subsidized solar. And if you look at Germany, Germany is not where you would naturally decide to put solar panels, right? Germany is about as sunny as Canada, right? But the German people thought it was the right thing to do, and now they are suffering. The reason that Germany has the most expensive electricity retail in Europe is because they're paying off the cost of deploying a very large amount of solar when it was 10 times as expensive as it is today in a place with the sunshine of Canada. But the German people gave a gift to the world in the same way that Portugal did in wind. They started that virtuous cycle spinning, which brought the costs down. And now in Portugal, wind has become cheap enough to re-enter without subsidies. And now in Germany, even, they are able to reap the benefit again. Because now, just earlier this year, we had solar power bids in the south of Germany at an incredibly low price, 4.3 euro cents a kilowatt hour, about 5 US cents a kilowatt hour. That's less than the cost of coal and way less than the cost of gas in Germany, not a sunny place. And so you see, here's what's happened with German solar auction prices over just the last 2.5 years. They've dropped in half. Now, what does that say about Portugal? Because I will tell you that the least sunny place in Portugal is sunnier than the sunniest part of Germany. And so we will see prices come down. And in fact, just this year, we have seen the first unsubsidized solar projects happening in Portugal. They're still actually, they're about the same price as those German projects, maybe even a little bit more. But as the industry scales locally, you should see below 4 US cents, maybe 3.5 US cents for solar, if we can learn from what the Germans have done. And neither of these prices about wind or solar, these are not endpoint prices. This is the most expensive solar will ever be from now on, is today. Solar should drop in price by another factor of 2 to 3 over the next 10 to 20 years. And wind should drop in price by 30 to 50%. Offshore wind should drop in price by half again. So we will keep seeing these prices decline. Now, it's true that we do have some challenges with the solar and wind. A fossil asset is dispatchable. You can decide when to produce electricity. With solar, what happens if the sun isn't shining half the day? Or what happens with wind if the wind isn't shining? Well, it turns out the best thing you can do is actually put them together. Here's a perfect day in California. At noon, the sun is shining, and you have your solar output maximum, and then statistically, the wind blows more at night. Or if you look at it over the course of months, of a year, in Germany, you see the solar peaks in summer, in June, July, and the wind peaks in winter. And so they're complementary. And in fact, if we get even more granular, you can see in the US, day by day, average out over 36 years, the solar compensates in the summer for the low wind, and the wind compensates in the winter for the low sun. But the thing about this is, the US is the size of a continent, more or less. And the best way to get this complementarity, or even to get reliable wind or reliable solar, is to build grids the size of continents. So if it's cloudy here on a certain day, it might still be sunny somewhere else. Or if it's winter and you decide to deploy more solar and there's less sun in Portugal, you can get wind from the North Sea or something like that. And so the future for electricity in Europe can't be a set of energy islands. It needs to be an energy continent that integrates. And Europe has started on this. There are interconnectors between all of these nations, but it's really still a set of islands with very, very small bridges from island to island. And it needs to become more of a superhighway linking these places. And with that, you can get to 80% maybe of all electricity produced just by solar and wind and smart balancing of them. But to go further, to close the loop, we need to crack this. And this energy storage is now the most exciting area in clean energy, at least in clean electricity. All right, let me show you. You all know who this guy is? Who is he? You all said Tony Stark, right? Okay. Elon sometimes acts like he thinks he's Tony Stark, but the point I want to make is this. He's not, and it wasn't some magical creation of the arc reactor that allowed Tesla to start selling this product, the Tesla Powerwall. Instead, it was that lithium-ion batteries are also an exponential technology. Let's look. Here's what's happened to the cost of batteries since 2010. They've dropped by a factor of 5, 80%. In fact, this year, it looks like they're already about $150 a kilowatt hour. So really, they've dropped by a factor of 86%, by a factor of 6, something like that. They are just an exponential technology with dozens of companies going after this. And here, I will say, and I'll come back to this theme a lot, forecasters completely missed this exponential trend. Forecasters think linearly where technology advances exponentially. Let me show you. Here's a set of forecasts made for what the cost of batteries would be. It was made in 2013, and the yellow line there is the US Department of Energy, and this is going to be amazing. We're going to see by 2048, 35 years, the price of batteries will drop by about 35%. 1% a year. Awesome. Huge innovation. Here's what actually happened. All right? We have status quo bias. We are humans. We evolved in a period when no technology change happened at all. And so that's just how we think. So we make forecasts that assume technology barely changes, when in fact technology changes exponentially. Now, batteries are still expensive, actually. To round trip a kilowatt hour of electricity into and out of a battery is maybe 15 cents a kilowatt hour now. That's way more expensive than natural gas or coal or solar or wind, but they're still dropping rapidly. But that is actually cheap enough to do some powerful things. Because behind the scenes, the price of electricity fluctuates throughout the day. And in places that have a lot of solar, what you see is the price is super low, maybe 2 cents in the middle of the day now. But then, as the sun starts to set, and people are still going home, turning on their appliances, their air conditioner, demand is still high, and supply of some solar is dropping, so the price shoots up. And so now people want to fill those late afternoon, early evening hours. So in in Arizona in the US, a utility wanted power from that 4 p.m. to 8 p.m. block. That was their new peak load. So they put out an auction for this. And normally this would be natural gas. The US has cheap natural gas. There is no doubt natural gas is what would have won this. But it didn't. First Solar, a US solar company, that makes its panels in Malaysia, won this bid with solar plus batteries made in China, right, in Arizona, right, because they are cheap enough to fit the wholesale power price at that time. And from here, they will just keep growing and keep dropping in cost. And in fact, we see they drop in cost at the exact same pace as solar, more or less. And that's just one energy storage technology. Behind lithium-ion batteries, there's dozens of additional battery technologies. I'm an investor in a couple of them. Here's one. This is a company I invested in called ESS. They make a flow battery. It's gigantic. It's heavy. You would never put it in your car or in your pocket because it would just be too bulky. But a lithium-ion battery might be good for 1,000 charge-discharge cycles. That's why your phone battery starts to get really bad after a few years of owning it, right? This is good for 20,000. You can deploy this at grid scale for 30, 40 years, and that makes the cost per usage lower. So batteries, too, will keep dropping in prices, and we will see them hit a few cents per kilowatt hour. Now, I want to come back to this notion that forecasters have just missed this trend. You saw Jeff yesterday talked about a chart like this, that we make linear forecasts. We see new exponential technologies, and at first they're extremely disappointing. Wind is too expensive, solar is too expensive, batteries are too expensive. But if they're improving exponentially, they hit a crossover point, and then they scale in ways we would never have believed, and it looks like a surprise. Right? So here's the most classic version of that is the world's leading expert on energy is the IEA, the International Energy Agency, part of the OECD. And let me show you how they have forecast solar year over year versus what has actually happened. See a black line growing, that's what actually happened, and the colored lines are the IEA's forecasts year over year. That they're always not just getting it wrong, they're always playing catch up to what's actually happening. Right? Every year, what they're actually doing is they're making forecasts of linear growth rather than exponential. Now, who thinks that 2017 forecast actually looks pretty good, right? They're starting to get it, maybe? Let's put that in another context. Let's show you, this is their forecast for total amount the world will have installed throughout history. Let's make it a forecast of how much will the world install new each year. And of course, every year they change what that forecast is. And what happens is this. Every year, they basically say solar has hit the peak of the amount we'll ever install, and from here on out it's linear. We'll just keep installing the same amount, henceforth, forever, but the actual growth is exponential, right? It's like someone, besides that last one, it's like some analyst is looking at their spreadsheet for each year and hitting Control-C, Control-V to move the formula to the next year, more or less. That's more or less what's happened. They forecast linear, flat growth, zero growth, actually, when the actuality is exponential. Now, that last forecast, 2017, this is their 2-degree scenario forecast. This is, they say, if the world gets super aggressive on policy, maybe we could hit that. In fact, that's slower than the industry forecast of what will just happen with no changes in policy around the world. Here's a different sort of, this is a retrocast. This is a historical look rather than a forecast. This is AllianceBernstein. They're a private equity firm, and they put out a report with this chart looking backwards. They put this out 2013 or 2014, and across the bottom they have coal, gas, and oil, basically. And then what's that on the upper right, that gray line? Is it someone's kid took a crayon and scrawled on their parents' report? We don't need that much light. Anyway, is that what happened? Somebody's kid's like, oh, Mom, I'm just going to like, shh. No, that's the cost of solar coming in. This is a 70-year chart. It's the cost of wind. That's the cost of batteries coming down. That is what disruption looks like, right? And so now we see it. Last year, China scrapped plans for 150 planned coal power plants. 40 of them, the ones in red, had already started construction. Billions of dollars spent and just written off. Right? India, in 1 month last year, in June, canceled $8.9 billion in coal investment. And the reason they gave was clear as day: the cost of solar is in free fall. Why would we build coal now? Right? So this starts to look like a Kodak moment for the industry. That used to be a good thing, I guess. But that's not far enough. That's comparing the cost of building new solar versus new coal or new gas. But we already have thousands of coal and gas power plants around the world. What happens to them, right? Well, earlier this year, the CEO of NextEra, which operates Florida Power and Light, a large utility in the US, had this to say. He said that by the early 2020s, building new solar or wind would be cheaper than operating their existing coal fleet. That's crazy. But that's what's actually happening. And we can see it in analysis. Here's the cost of coal, operating cost, not the capital cost, just the OpEx, and here's the cost of new solar. That is real disruption, right? And that will take a little bit longer to come to Europe. It's not as sunny here as it is in the south of the US, but it will come. Now, because of the times and because of where I'm from, I do get asked about this guy, right? And the good thing about Donald Trump, there's a good thing about Donald Trump, which is he's only the President of the United States. And the President of the United States can't change the laws of economics and really can't change much about the pace of global innovation. So in the first 8 weeks of Trump's presidency, the US shut down more coal plants than in Barack Obama's first 4 years. And we had a survey done, Reuters did, just about a week ago of utility CEOs in the US about what are their plans on coal, and they all said, unchanged. We are continuing to shut down, shut down, shut down. That's what's happening. All right, all of that was just about electricity. But there's this other way that we use energy, which is to transport us and our goods around. And that, overwhelmingly, we do with oil. And oil is this incredibly important commodity that's also incredibly volatile. $2 trillion commodity that gyrates from $30 a barrel to $150 a barrel over the last 20 years. And that's happened because of a 2% swing in supply-demand, a 2 million barrel a day supply-demand imbalance in a 100 million barrel a day market. That's crazy. But that's how volatile it is. And right now it's high. But it's basically impossible to predict the short-term price of oil because of this. But I think we can predict the long-term price of oil. And the long-term price of oil will be low because we will be using less of it. Coal demand peaked in 2013. Oil demand will peak. I'm not the first to say this, or even the 10th or the 100th. Actually, the first person I know who said this was the Saudi oil minister during the OPEC crisis. Sheikh Ahmed Yamani, in 2000, said this to his fellow sheikhs. He said, guys, the Stone Age didn't end for a lack of stone. The oil age is going to end with oil still in the ground, saying the world is going to invent better technology. We invented bronze. We're going to invent better technology, and that's a threat to us, to Saudi Arabia, right? It's a threat to any oil producer. And now we see it's not just one technology, it's 3. It's using apps to call rides as a service and pay for rides rather than pay for cars as capital. It's self-driving, and it's electrification. And those 3 together are greater than the sum of their parts. Let me show you. Calling rides, paying for them as a service has changed everything. Taxis in America peaked at 1.4 billion rides a year. Uber and Lyft will do 4.2 billion this year. They didn't just take market share, they grew entirely new markets by being more convenient, more reliable, and cheaper. And that matters because when you pay by the ride, electric gets an advantage, as we'll see. And in fact, Uber and Lyft grew in part because they are typically priced about half of what a taxi is. A taxi is about $3.50 a mile in the US, and Uber is about $1.50 a mile. That helps, right? Okay, second, autonomous driving. Autonomous driving is almost here. It's very, very close now. These things will simply be better drivers than us. In the same way that AI has beaten us in chess, in Go, is about to beat us in reading X-rays and MRIs, it will just beat us in driving. And we see that right now. 2 companies, Waymo, which is Google, and Cruise, which GM bought for $1 billion, are both on the cusp of large-scale, autonomous, Uber-like fleets. Now, people say, is that really true? How do you know? Well, I can quantify it. I can quantify how safe these vehicles are. We use a metric called miles between disengagements. How many miles does the vehicle go before it has to ask a human for help? And if we can hit about 50,000 miles between disengagements, that's 5 person-years of driving, and we think that's good enough. So in California, we have to get data given to the state for the tests that are done. And last year, in the second half of 2017, Waymo drove 7,500 miles between human disengagements. By November, they were up to 30,000 miles between human disengagements. Then in March, they've had a beta going in Phoenix, Arizona. In March, this beta that has 400 families can use an app to call a Waymo, they took the human safety driver out. In May, they announced at Google I/O, Google's big conference, that by the end of this year, they would have this commercially available in Arizona. Now it's October, it's getting pretty late in the year, they might not make it. But even if they're 6 months late or a year late, this is happening. Meanwhile, GM bought this startup for $1 billion when it was a year old. SoftBank just put another $2.5 billion in. Honda just put another $1 billion in, valuing it at $12 billion. And they say by end of next year, they'll have a commercial fleet running. So how does that intersect with the other trend? Well, an Uber is half the price of a taxi, $1.50 a mile. Half the cost of an Uber is the wages of the driver. So now you're talking 75 cents a mile. But then those Ubers will all be, those autonomous Waymos and GM Cruises, that's an electric vehicle, it's a Chevy Bolt, basically, they will all be electric, because electric is just cheaper per mile, per kilometer. We've already seen what's happened. Electric vehicles have changed. This is an EV of 12 years ago, right? Who would want to drive this thing? Nobody. But Elon and Tesla disrupted this. And most disruption, you heard David Roberts say, most disruption comes in from the low end, right? But Elon came in from the high end. He had a secret plan for how he would disrupt this industry. It was so secret, so important to him to maintain the secrecy around this, that he put it on the Tesla blog in public, and it basically says, here's what we're going to do. He says basically this diagram. He says, look, we're going to change the world. We're going to save the planet, and we're going to do it this way. We're going to make a $250,000 sports car. We're going to sell a few thousand of those. OK, that's not very world-changing. All right, but that's going to get us to an $80,000 luxury car. We're going to sell hundreds of thousands of those. OK, still not very world-changing. That's going to get us to a $35,000 family car. It's still a luxury sedan, but a low-end luxury sedan. We're going to sell millions of them. By the way, this is now the best-selling vehicle in its class in the US, not against electric, but against all vehicles of this category, if you will. Now, Tesla, who knows, they're just one company. They're having some challenges. They might go under, and I hope they don't. I'm a big fan of Tesla. I want them to survive. But if Tesla went bankrupt, it would not change what's going to happen in transportation. Because now every company in automotive is going after this. Volkswagen spent $25 billion earlier this year just to secure battery supply for their next few million vehicles. GM announced earlier this year they had an all-electric future. Right? Toyota is moving into it. Nissan is already there. And EVs are still tiny, 0.5% of all vehicles on the road by the end of this year. Still very, very small. But the first million EVs took about 20 years. The second million EVs took 18 months. The third million EVs took 8 months. The fourth million EVs took about 5 months. That's the pace of growth. And again, the forecasters missed it. Here's the US Department of Energy again. Here's their forecast for how many electric vehicles would be on US roads with a 100-mile range, blue line, or 200-mile range, red line, 20,000 by 2040. How many Model 3s has Tesla pre-sold? About 500,000. One manufacturer in 2019 will deliver 25 times what their forecast was for 2040 for the entire industry. And so you see, now, all of the forecasters out there, energy companies, analysts, IEA, are lifting their forecasts. You see, the IEA increased their forecast by a factor of 5 over the last 2 years, from 2016 to 2018. You have Exxon has boosted their forecast. OPEC has lifted their forecast, actually one of the more optimistic ones. BP has lifted their forecast strongly. Even Bloomberg, which has always been optimistic, has lifted their forecast to 600 million electric vehicles on the roads by 2040. And if you play these out, what it says is that peak sales of gasoline cars will occur by 2023. But even that's missing the point, because the way that people will experience an electric car for most people is not going to be buying one. It's going to be calling a service that comes up with electric. Because electric vehicles, while they're more expensive up front, are already cheaper on a per kilometer basis. Let's look at that. Here's a 4-year cost of ownership of an electric vehicle versus petrol in London from a study earlier this year. Here's the gasoline vehicle. See, it's the blue bar is how much it costs to buy it, and the orange is the fuel. Here's electric. Costs more up front today, but the electricity costs almost nothing, and also the maintenance costs almost nothing, I will tell you. So already on a per kilometer basis, the electric is cheaper. And so if you're buying up front, you might say, well, it's cheaper up front for the gasoline car. But if you're calling an Uber, are you going to pay for one that's more expensive and also is noisy and sort of a little stinky? Or are you going to get the sleek, modern, futuristic one that's very comfortable, right? And cheaper. Now, this is the most expensive electric vehicles will ever be. What's the most expensive part of an EV? The battery. So what happens as we sell more electric vehicles, we sell more batteries, what happens to battery costs? They go down. Battery costs go down. What happens to the cost of whole EVs? They go down. So what happens to the sales of EVs? And over and over and over again. And ultimately, they will be much cheaper even up front than gasoline vehicles. And here's why. This is the entire engine and drivetrain of an electric vehicle. Specifically, it's a Tesla. Right? Here is the engine and drivetrain of an equivalent gasoline vehicle. Has 10 times as many moving parts. So maintenance cost is higher, and manufacturing cost is higher. The only reason this is more expensive than this today is because electric vehicles are made at small scale, and batteries are still a bit expensive. And electric vehicle scale is growing, and batteries are plunging in cost. So ultimately, they will be cheaper, not just operationally, but upfront. Don't just take my word for it. Let's ask Ford. Here's what Ford says. Ford did an analysis, and they published this in a press release actually last year. And they said, when we look at how much we have to invest per vehicle, we look at, here's the factory space we need. Electric is half as much. Here's the capital cost to build the factory. Electric is half as much. Here's the total labor hours per vehicle. Electric for the drivetrain is actually 1/5 as much, 80% cheaper. But electric vehicles, the seats and the panels and the windows aren't any cheaper. So the overall cost, 30% lower for labor. So when you add that up, what you get is this. It's not that electric vehicles are going to be 20% cheaper per mile. It's that they're going to be less than half as much per mile as internal combustion. And so again, well, this plus autonomous will boost Ubers or Waymos or Cruises because it'll be so cheap, and that in turn will boost electric, right? And so if you play this out, what multiple different analysts, including fossil fuel companies, have found is that the cost of an autonomous electric vehicle will not be $3.50 like a taxi or $1.50 like an Uber. It'll be 35 cents a mile, 20 cents a kilometer. And that's basically competitive with buses and with trains. And that's for a single occupancy vehicle. If you make that a shared vehicle where you have multiple people inside of it, and like a small bus, for instance, in every country I go to, there's one of these, you get to 10 or 15 cents a mile, 6 to 10 euro cents, or 6 to 10 US cents a kilometer, all right? And so again, we miss this huge exponential, because as you cross those tipping points, consumers switch behavior. How fast? Well, we don't know. But here's one piece of data. When Uber dropped its price from $3.60 to $1.50, 58% price reduction, their miles driven went up by a factor of 8. And so we have this massive potential. If you look at forecasts of EV growth, that's the blue line. It's an aggressive forecast, but not totally implausible. But what's going to happen is that miles driven, kilometers driven in EVs will rise faster, because the internal combustion car will sit around as you take these cheap autonomous electric vehicles to work. And that looks like 15 million barrels of oil demand destroyed quite rapidly. And now passenger vehicles are just a quarter of all oil consumption. But as we go through the rest, heavy trucks, they're getting there. They're one of the harder ones. Light and medium duty trucks, they are basically on the verge of crossing this as well. Lubricants, half of all lubricants go to cars. Electric cars basically don't use lubricants. They don't use engine oil at all anyway. So you end up with a high risk of disruption for about 1/3 of all oil, and a high or medium risk of disruption for more than half of all oil. And now oil majors are seeing this too. I spent a lot of time with oil companies in Europe, more than in the US, but both. Total says peak oil demand, 2030. Statoil says sometime in the 2020s. Sorry, Equinor is their new name. Shell says sometime between 2021 and 2031. The IEA says actually oil demand will keep growing forever. Bloomberg, New Energy Finance, says this is what will happen. I actually think Bloomberg is being sort of overly optimistic about the short term. They're saying 2020. I find that hard to believe. But they're underestimating the long term. What we know about exponentials is they start off slow and they're deceptive. Then they get bigger and bigger and bigger. So I think the real shape of the curve, I'm not saying the actual numbers, but the shape of the curve looks more like this. All right. I want to close with how can you take action in a market that is being disrupted so fast? Well, the Chinese character for crisis, some people say, is danger plus opportunity. It's sort of an oversimplification, but it's close enough to that. And we have massive danger. I've barely even talked about climate change. But the longer we wait to start decarbonizing in a serious way, the steeper we have to decarbonize. It gets harder and harder to stay under 2 degrees Celsius. Right? And the flip side of that is, if we want to decarbonize, if we want to stay under 2 degrees Celsius of warming, about 3/4 of the world's known resources of oil, coal, and gas can't be burned. So that becomes a stranded asset, sunk cost. How big is that? Well, Citi, those hippies at Citi, say the total cost of unburnable resources plus power plants that are stranded and so on is $100 trillion US dollars. Not 100 billion, that's small. 100 trillion US dollars. Have you ever seen a number so big? Right. In disruption, there are losers, but there are also winners. So I'm going to give you a few pieces of advice of what you can do to avoid losing and hopefully win in this transition. And the first one is very, very technical. It is this: cover your ass. Like, hedge your bets, because you didn't want to be caught holding coal stocks when that happened to coal, and the price of oil is quite high right now, but no one wants to catch a falling knife. Number two, here in Portugal, if you have a factory, an office building, a mall, reduce your costs. It is now going to be cheaper for you to put solar on your roof, and you'll get more and more rights to do so, than it will be to buy retail electricity for quite some time. Number three, get energy independent. Despite Portugal is one of the leaders in clean energy, half of Portugal's electricity comes from fossil fuels, and Portugal still imports, 6% of its imports are crude oil. In fact, in total, 75% of Portugal's energy is imported. And there's no problem with importing some, but you should be exporting at least the same amount. Get at least energy interdependent, where your exports and imports are similar, or in fact, use it as an opportunity, which I'll talk about in a second. 4, learn from other nations that have made market reforms. The blue dots are an old way of doing business in solar and wind, and the red dots are a movement to an auction model with these long-term contracts called PPAs. It's a policy change that's sweeping the world, and Portugal is only slowly getting into that, and that by itself has a massive impact on prices. And 5, energize your economy, and you can do this in 2 ways. You have sunk cost of what's happened to fund wind up until now. Maybe you'll renegotiate those contracts, I don't know. But those subsidies will eventually end and those taxes will go away, and your prices of electricity will drop. But beyond that, if you look to the future, Portugal is one of the sunniest places in Europe, which means in the long term, it should have some of the cheapest electricity in Europe. And that cheap electricity should attract businesses, should attract manufacturers, should attract energy-hungry companies. And what's more than that is you have an opportunity. If we're building an energy continent, Portugal has an opportunity to be exporting solar to its neighbors, France, Germany, the UK, that all badly need it in the summer. And finally, invest in the future. The world is going to spend tens of trillions of dollars deploying clean energy and clean transport solutions. There's many ways to invest in that. I told you I invest in this. If you're curious, you can look me up. There's ways for you to join me in investments. And I will end on a philosophical note. You heard Jeff talk about the cray in your pocket. Here's my version. I went to the University of Illinois, Urbana-Champaign. That's ILIAC, second digital computer ever built, larger than this auditorium, weighed tens of thousands of kilograms, drew tens of thousands of watts of power. And next to it is an obsolete piece of technology, iPhone 6. This phone weighs tens of grams. It draws thousandths of a watt of power. It is tiny, and it is billions of times more powerful than iliac. So what I want to ask you is this. Philosophically, how is that possible? How can something that is smaller and draws less energy and lighter do so much more? Isn't that a violation of conservation of energy or conservation of mass or something? Isn't that breaking the laws of the universe in some way? And my answer is this. This object is not made of matter. This is not made of glass or silicon or rare earth metals or plastics. This is made of ideas. This is made of information, scientific discoveries, engineering discoveries, software advances, and knowledge. Ideas have a radically different economics than matter. They have a positive sum economics. If I throw this phone down, I'm not going to, but if I do, I will no longer have a phone. But we will still have all the knowledge necessary to make all the phones we want. And in fact, it's better than that. If I've given you an idea today, I am no poorer. And if we exchange ideas, we both have more of them. And our ideas meet and collide and give birth to new ideas that can replace the most scarce matter or labor or land. Ideas are the ultimate multipliers of the value of all other resources, and they are the one natural resource we have that is always growing in number rather than declining. And that is what makes me an optimist. Thank you very much.
All right. Thank you, Ramez. We have some questions for you.
All right.
And I think we have a few minutes for them. Are you ready?
I'm ready.
Okay. Excellent. We're going to take a couple off the top here. So the first one I like, and I'm going to build on it a little bit. You've been asked, how much time do you spend with policymakers? And I'd like to broaden that and also ask, how much time do you spend with some of the big established energy companies, oil companies, and what kind of response do you get?
Yeah, so I spend time with policymakers, though I'll be honest, I spend more time with innovators and startups because they're a little bit easier and more fun to work with. But there are some amazing policymakers out there, and I do try to spend time with them. And I spend a lot of time with big energy companies, with both big utilities and big oil companies. And I'd say the response overall is positive. It varies between who the person is, but people get this. The response is different than it was. I started talking about this in 2011, and the response then, particularly in the US, was to scoff. In Europe, you were a bit further ahead. Now, it's happening and it's obvious, and the response is really how do we pivot? How do we make new investments in this area?
Another one that I think is good that I'd love to hear a little bit more on here. When we're thinking about the energy future, it seems like batteries will play a very significant role in that, and that we're going to need to have some advances in how we either recycle or manage the waste produced by batteries. Can you sketch briefly what that might look like?
Yeah, up until now, we haven't had a battery recycling supply chain because the number of batteries and volumes has been so small. But now you see it happening. So for instance, Tesla pays a company headquartered here in Europe for each battery pack that comes off a Tesla to be recycled. And as the volume of electric vehicle batteries is going up, every auto OEM except Tesla is planning to use batteries that have been depleted maybe 10 or 20% in a car, enough that a car owner would be unhappy, but are still good for other uses, use them a second time in buildings, and then beyond that we'll get more and more recycling advances.
And what about nuclear? I know you field this question often,
yeah,
but it also pops up often. So why does that not figure more prominently in the conversation?
I love nuclear power, and in Europe and the US it's dead. And the reason is economics, that unlike every other technology I just showed that has a learning curve where the price drops over time, nuclear has a negative learning curve. That is to say, nuclear has gotten more expensive over time. The industry has failed to innovate, and they failed to even maintain a healthy supply chain. They failed to build things in a repeatable way. So nuclear might have a future in China or India, but even leaving aside sort of the social fear questions, which I do think are a problem, and I do wish that Germany and other European countries with nuclear would keep it running, but building new nuclear is just not going to happen because wind and solar are outcompeting it.
Given, I think just yesterday there was another UN IPCC report released that looked very, very dire and said that we may have a decade really, to coordinate global response and radically transform the economy. Do you believe that the future that you're forecasting here and the technologies that we're talking about will be adopted at sufficient scale with sufficient support to actually, if not avert some of the worst of the climate crisis? Yeah. Or how do you think about mitigation in conjunction with this future?
Today, we are losing ground. Today, if you just looked at sort of terrain on the ground, we're losing to climate change. Carbon emissions are going up, concentrations in the atmosphere are going up. I don't think we're going to keep it below, we're not going to keep it below 1.5 degrees Celsius. We maybe have a small chance at 2 degrees, but 10 years ago, the business as usual model, what the IPCC would forecast, was 6 degrees Celsius of warming by 2100. Now the business as usual forecast is 3 degrees warming by 2100. That's how we've bent the curve through new technology, and I think we'll keep bending it down. So I would love to say we're going to come in below 2 degrees. I don't think so, but I think we'll definitely come in below 3 degrees and probably below 2.5, and I think that has some serious problems, but I think humanity is also much more adaptable than we give ourselves credit for. It would be more beneficial, it would be a net profit if we just invested harder and faster, but even with some of the short-sightedness, I think we will turn the corner and still be better off, for the most part, in 2100, even with climate change, than we are today.
One more I'd like to close with. You know, every time I intro you at one of these events, I talk about your background as a computer scientist and a programmer and your work as a sci-fi writer, and I know you wrote a great book on the future of human augmentation. On the theme of adaptability, how did you come to the work that you're doing currently?
I fell in love with the planet on a beach when I was a software engineer. I started reading everything I could. I'd written one book before, and I thought, I'm going to write a book about this. And that got me here. But the main lesson I would have from that is you can become an expert in anything today. And people ask me sometimes, what should they teach their kids? I say two things. Teach them to code, but then teach them to teach themselves. Because today, almost anything you want to learn is available to you on the internet, and if you take the initiative, you can go become an expert. I've never taken a class on energy in my life. I have no degrees in it, and yet I have a decent expertise in the field because you can teach yourself anything today.
On that note, Ramez Naam, thank you very much.
Thank you, Jeff, and thank you all.